Have you ever looked at the sheer number of mutual funds out there and just wondered, how do the pros do it? How do they find the real winners? Well, it's not luck, and it's definitely not guesswork. It's a system. And today, we're going to pull back the curtain and show you the exact playbook that institutional investors use.
I mean, it really all boils down to this one big question, right? You're faced with this huge ocean of options, and trying to pick the right one, it can feel completely overwhelming. How do you find that signal in all of the noise?
And that's not just a random number. Right now, as an investor, you're looking at a universe of 696 open-ended equity mutual funds. It's an absolutely massive number. And just picking one at random, that's like trying to find a needle in a haystack, blindfolded.
So what's really at stake here? Well, this number. This is the average performance difference per year between the best and the worst funds over the last decade. 52%. Getting this wrong isn't just about missing out on a few gains. It can be a massively expensive mistake.
And that brings us to the most important point. Without a disciplined, rigorous process, the kind the big institutions use, your chances of consistently picking the top funds are, let's be honest, pretty slim. Hope is not a strategy. A solid process? That's everything. Okay, so if process is the key, what's the actual goal of that process? Well, it all comes down to the hunt for something Wall Street loves to call alpha.
Simply put, alpha is the secret sauce. It's the extra return you get above what the market gives you. It's proof that your fund manager is actually earning their keep, making smart calls that beat the average. It's the ultimate measure of skill.
And don't underestimate how powerful a little bit of alpha can be. Just look at this. If you invest 10 crores and get a standard 12% market return, in 10 years, you'll have about 31 crores. Not bad. But if you can add just 3% of alpha on top of that, that same 10 crores balloons to over 40 crores. That 9 crore difference is almost your entire starting investment back, all from that little bit of extra skill.
And that, right there, that becomes our target. The whole process we're about to walk through is designed to build a portfolio that consistently aims for that extra 2 to 3% of alpha. It might not sound like a lot, but as you just saw, over time it compounds into some serious wealth.
So how do you actually go out and find this alpha? Well, it's not about one single magic bullet. It's more like a blueprint, a strategy that targets 3 very specific sources where you can find that outperformance. It all starts with market cap allocation. That's just deciding how much money goes into big, stable companies versus smaller, high-growth ones. Next up, you have category selection, choosing which sectors you think will do well, like tech funds or healthcare funds. And only then, right at the very end of the process, do you actually get down to picking the individual fund or the scheme. Every single step is a deliberate choice designed to stack the odds in your favor. All right, enough theory, let's see this thing in action. This is where it gets really interesting. Watch how this institutional selection funnel takes that massive universe of funds and just ruthlessly narrows it down to a tiny handful of potential champions.
So we're back at the starting line, the whole shebang. Nearly 700 funds, all competing for your attention and your money. Our job is to systematically cut through the noise.
The first cut is pretty simple, but it's absolutely critical. We screen for a minimum AUM. That's just assets under management, a fancy way of saying how big the fund is. If a fund's too small, it can be pretty risky. We also immediately get rid of any fund that doesn't have at least a 3-year track record. You need to see how it performs in different conditions. And just like that, with one simple filter, the universe shrinks dramatically. We've gone from almost 700 funds down to a much more manageable, but still pretty big, pool of 177. Okay, now it's time for the heavy lifting. This is where the nerds and the supercomputers get to work. These 177 funds are put through an incredibly intense quantitative screening, where we analyze over 100 different statistical data points. It's a purely data-driven step, looking for the telltale signs of a fund that's built for outperformance. And what's the result? Only 36 funds managed to get through this grueling data gauntlet. Think of it like an Olympic trial for mutual funds. These are the ones that, at least on paper, have the stats of a champion. But we're not done yet.
Because, you know what? Numbers only tell you half the story. The next step is all about the human element, the qualitative review. This means sitting down face-to-face with the actual fund managers. You want to look them in the eye, understand their philosophy, and really get a feel for the conviction they have in their strategy.
And after those meetings, guess what? Another cut. You'd be surprised how many funds get eliminated at this stage.
Maybe we're not convinced by the manager's strategy, or maybe the team doesn't seem strong enough. Whatever the reason, we're now down to just 23 elite schemes.
And for the final decision, we bring in the heavyweights, an 18-member investment committee. And we're talking about a group with over 300 years of combined experience in the markets, spends more than 500 hours debating, stress testing, and tearing apart this final list.
And this is what you get at the end of that entire exhaustive process. From a universe of nearly 700 funds, we arrive at this, a final, highly curated model portfolio of just 14 schemes. Every single one of them has survived round after round of the toughest scrutiny imaginable. So after all of that work, what does this portfolio actually look like? What's it built to do? And more importantly, what's the big takeaway for you as an investor?
Well, here's the payoff. This chart shows the projected earnings growth for the coming year. The broad market, represented by the Nifty 50, is expected to grow around 11%. But the model portfolio we just built? It has a weighted average earnings potential of 21.5%. That is nearly double the market. This right here, this is the engine that's going to drive that future alpha.
Now, this is a super important piece of wisdom to remember. You can't expect every single fund in the portfolio to be a winner every single year. That's just not realistic. The real power comes from the entire basket of funds working together as a team. Some will do great one year, others will shine the next, but the goal is for the portfolio as a whole to deliver that consistent alpha.
So I'll leave you with one final question to think about. When you look at your own investments, is your process built on a solid foundation, designed to find alpha? Or is it based more on recent headlines and just a bit of hope? Because in the long run, the only reliable way to win this game isn't by getting lucky, it's by building a winning system.